Margin trading is very complicated. When you try to get the data, oftentimes at every single gain calculation company, you're going to see discrepancies between what actually happened and what you actually saw.
At CryptoTaxAudit, our team with Ben Weber heading up the gain calculation are complete animals. They rip apart this stuff. We've done people with 5 million transactions in a year, DeFi, high volume transactions. They come up with a gain calculation that we can defend in audits. We've never lost before the IRS in an audit gain calculation that we did.
Margin trading is very complicated specifically because so for instance, in KuCoin, if you're doing margin trading, futures, any of these advanced products, oftentimes there's a separate API just for those trades. They don't go with the spot trades. The data doesn't go together. Same with, Binance. So Binance FTX, when they used to allow, margin trading and such, the software, all the crypto game companies, they integrate one piece at a time, and the data behind margin trades is often not the same as the data behind spot trades. And by the way, this is even worse in DeFi too. On DeFi, every single protocol that lets you do futures leverage trading is different. So when you try to get the data, oftentimes at every single gain calculation company, you're going to see discrepancies between what actually happened and what you actually saw. From personal experience at the company that I used to work at, we had a guy who used to trade margin on Binance, and I asked him one time, like, hey, how do you keep track of this? He said, honestly, I just look at my account on Binance because the P&L there is a lot more accurate. And again, it has a lot to do with the data points. There's a lot of data that you're not getting because a lot of these, when you're doing margin trading, oftentimes you just keep track of the P&L. The USDT you put in, the USDT you took out. So, Clinton, unless you have any other advice, my personal recommendation in that case is just keep track of your P&L, keep track of what went in, what went out. And at the end of the day, I take an approach, simplicity is better in this case. You could go overly complicated trying to get all this data, but you're going to spend hours trying to get data that's going to give you a result that's probably inaccurate. So if you know that you put in, I don't know, $40,000 into it, and then you came out with $20,000, I'd feel pretty comfortable saying that's a $20,000 capital loss in your 8949.
Well, I think that's great advice, David. Let me approach it from a slightly different angle. The IRS the government wants you to pay taxes on your income. The question is, what is the income? Well, we know it's really difficult to calculate it from a bottoms up point of view, which is what these tools are doing. They're taking all this transaction data and trying to calculate it up to come up with some magical number. The problem is there's holes in the data, and we get silly numbers. What you're recommending is, and what this client suggested, is basically I'd characterize as a top-down approach to estimating. He's got, binding it saying, here's what my P&L is roughly in this area. If he believes that number, and he has confidence in that number, I would say report that number on your tax return. You can't necessarily go prove exactly from a bottoms-up calculation that exact number, but in an audit, we can whip out the big guns and we can get you pretty close to that number. And if in a final analysis, if we get experts in there analyzing your gains, we come up pretty close to that number, you'll be doing all right, because you will have reported the honest amount of income you thought you made and paying taxes on that. I mean, we have some people that are quite large who have to resort to that approach of estimating their income. And my experience is that nobody knows better how much money you made than you did. And that is the confidence. And I actually heard a former IRS deputy commissioner who had been in charge of the cryptocurrency compliance campaign at the IRS, a person named John Cardone. He now works for RSM, one of the top accounting firms in the US. And he spoke about this, and he said, basically, do your best. And if you get audited, you'll do all right. That's what he said. And I think that's very good advice.
I think two points to make on that. Number one, if you are having problem getting the data, getting all the detailed transactions, guess what? The IRS is going to have the same exact issue trying to get the same data, because at the end of the day, they're using very similar tools to what retail taxpayers are using. They also need to try to get the data from these exchanges, the DeFi protocols that, again, they're going to have challenges with. So if you really are having trouble, I would say don't sweat it. As long as you do your due diligence, keep records of what went in, what came out, I think you'll be okay. Now, I got a question for you about that, Clinton. If you report it that way, you're technically not meeting the requirement on Form 8949 to report every single trade separately with the buy date, sell date, putting everything separately as required. Otherwise, they say if you can't provide this information, send us an attachment with information. Is that a risk if you're not doing that?
Correct. You're not giving them all the detail. You're not doing that bottoms up number crunching. But there's no penalty for doing it wrong. The penalty is for coming up with the wrong amount of tax to be paid to the IRS. That's the focus. So, all of this is to calculate how much your income is, subtracting the deductions, taxable income, and then how much tax you pay. So, ultimately, if you get audited, I mean, they can say things about you. You didn't do this right, didn't do that right. And who does in any field of tax? But ultimately what happens is when the auditor doesn't like what you write, he comes up with a final report. And I've seen dozens and dozens of these. Once you get past all the detail, it comes down to the dollar amount of taxes, penalties, and interest that you're off. And if the amount of taxes that you paid was more than they think you wanted, then they're going to give you a refund. So that's the only thing that matters. And that's the only thing that they can come after you for, is not paying the right amount of tax. All the rest of it is just, just being binged on the head. Now, that being said, during an audit, you're going to have to prove stuff. And if you can't prove it, that's problematic. Now, in a crypto audit, where does the IRS get transaction records? First of all, they ask it from you. Now, you probably prepared your tax return using an API key from Binance or KuCoin, or maybe got CSV extract files. And these are the things you use to plug into your tool to come up with your gain calculation. The IRS asks you for the CSV files. In fact, they do not use API keys because it has to do with some sort of privacy of data and this sort of thing. And they won't use API keys. So they will demand CSVs from margin trading accounts. In fact, we have one client who they demanded only the CSV files, not the API keys. I can't remember which exchange it was, but the API key pulled out all the margin transactions, both the winners and the losers. But when you got the CSV file did not have the same data. It didn't have any of the losing transactions, only the gaining transactions, or the when you put money in. And so when the IRS did the gain calculation, they were off by hundreds of thousands of dollars for this client, which is okay, because then we showed them that the data was wrong. We just shot holes in the IRS numbers, and it's helping us win the audit. So, it's a good thing. Now, where else does the IRS get audit information? They get audit information if they think that the client traded on Bittrex. He said, I opened up account, but I never traded there. But yet they thought he had an account there, and they thought he had transaction records, and they got a transaction file from somewhere. All right. So that's another approach. If they know about DeFi addresses you use, which is increasing, they may be able to pull transaction histories off the blockchain and apply that. It grows in the level of complexity, and IRS isn't necessarily interested in stepping up to all that. But bottom line is, if you report honestly the income that in your heart you believe you made, and you need to maybe understand what constitutes income, but if you report that income and pay taxes on it, you should sleep well at night.
I think that it's interesting that you mentioned that the IRS does not use API keys from exchanges, because, as you know, oftentimes, as you pointed out correctly, the CSV files tend to be incomplete, and their data APIs tend to be much better when compared to CSVs. Really depends on the exchange. the whole user experience can be very difficult getting CSV files. For instance, Binance, you have to get like, I think you have to get 4 per year, and there's 2 separate sets of CSV files, which the margin for error, not to mention that how you can rely on the CSV files, because at the end of the day, anybody can modify CSV file. API data, you get it directly from the exchange. But my question for you, and I think this is why, what does that mean for blockchain transactions? So they're okay putting in a blockchain address and getting data directly from the blockchain. And this is directly related to a question from the audience saying that they have overdue 2020 taxes and they need help getting multi-chain DeFi transactions properly accounted for. I mean, are you surprised that they're having issues calculating, getting data for, it sounds like a plethora of DeFi protocols? I'm assuming they're using more than just ETH.
Hey, look, the do-it-yourself tools out there really hit a wall when it comes to multi-chain, cross-chain, poly-chain type of transactions. And I will have to say that, quite frankly, at CryptoTaxAudit, our team with Ben Weber heading up the gain calculation are complete animals. They rip apart this stuff, and we come back with numbers. We've done people with 5 million transactions in a year, DeFi, high volume transactions. They come up with a gain calculation that we can defend in audits. We've never lost before the IRS in an audit gain calculation that we did. We've got a really good reputation actually at the IRS with the crypto specialist, subject matter specialist team. They know crypto tax audit gets it done. It's a losing battle to come up against us. I think it's possible the key thing is report the income that you know about, and you should sleep well at night. And make sure you have a strategy for protecting yourself in case the IRS comes knocking.
If I may add something to that, just because the service you're using is integrated to Ethereum, to Cardano, to Solana, to Matic, whatever blockchain you're using, don't just assume that it is reporting it and pulling the data correctly. I've seen a number of services where you put an Ethereum address, and if you trade it on liquidity pools, it doesn't actually get the transactions. Depending on what protocols you're using. If you're using Aave, Curve, a lot of these more sophisticated DeFi dApps, sometimes you plug in your Ethereum address and the data that it actually pulls is rather incomplete. So again, if you get the wrong result, don't just assume that because it imported the data, it is correct.
Well, that's very good, David. The online gain services, they do a little devious thing here. They'll say, if you upload your transactions from an exchange, we can calculate your gain. And we also support DeFi. Now, with DeFi, of course, you just give them the address and they're pulling the transaction records. And they say, we support this blockchain, this blockchain, this blockchain, all your DeFi transactions, we can bring them in. But they're not supporting them the same way they did for the exchanges. For the exchanges, not only can they read the records, they can understand the tax implications of the records. But with DeFi, they'll say, we can support these blockchains. It only means they can read the record. It doesn't mean they understand what the tax implications are. A lot of these DeFi transactions, the tax implications are buried inside the smart contract. And a lot of these services don't even read the smart contract. So they can read it, they can dump it on you like it's like, here's a dead fish for you, but you figure out what you want to do with it. I find when I read different websites that they're very subtle in not characterizing the level of quality that they bring to a DeFi transaction than they do to a regular exchange transaction. My opinion, we're taxpayers. Go out and do what you want to do. Invest where you want to invest. Keep a good sense of how much money you made. Report that at the end. And the more complex it is, the higher the likelihood is that we can defend you successfully in an audit, because the IRS won't be able to touch it. They just don't. They struggle to handle the complexity of our high volume transaction clients. They struggle with the complexity of DeFi. They really don't know how to handle that. So don't let yourself be paralyzed worrying about what the IRS can do or what these gain services can do in terms of calculating your gain. Just report the income you believe you made and just go out and trade as vigorously as you'd like to. And, in an audit, we can defend you usually fairly successfully. Thank you very much for listening to today's show. and I hope you enjoy it. Please give us comments. We would love to respond to any questions you give us. You have tax questions that we can apply to. We will try to address it in future shows. Please hit like, subscribe, follow. Thank you. Have a great day.
The Clinton Donnelly Show, where we explore how taxation and regulations of cryptocurrencies affect your daily life as an investor. Clinton has a law degree in international financial regulation. He is an enrolled agent and certified as a cryptocurrency anti-financial crime specialist. He has clients in 71 countries. He is one of the top experts in crypto taxation in the US. This show is sponsored by CryptoTaxAudit.com, the income tax experts for US crypto investors. Are you frustrated with using online crypto tax services to calculate capital gains? Are you a high-frequency trader, DeFi, NFT, play-to-earn, or whale investor? Nothing is too complicated for the experts at CryptoTaxAudit.com. Are you frustrated that your accountant doesn't understand crypto taxes? Crypto Tax Audit uses a proven, bulletproof crypto tax return methodology to prepare a tax return that doesn't attract the attention of the IRS. Crypto Tax Audit also offers an exclusive Audit Defense membership service. It's like car insurance for your tax return. If your return gets selected for an audit of crypto reporting, they will defend you at no additional charge for the entire life of the audit. No one offers anything like Audit Defense membership. Go to CryptoTaxAudit.com to learn more and schedule a private tax consultation now. The opinions expressed in this show are not legal advice. Tax and regulations are complicated. Your situation is unique, so you should always consult a tax professional.